So, chalo, today the session that we are going to cover is on NMDC, India's iron ore powerhouse. So, that is what we are going to cover. So, India's largest iron ore producer. So, it plays NMDC plays a critical role in steel industry because they are the largest iron ore providers in India. And of course, in this particular, and one more thing, their mode is low cost mining. So we will get to the mode part as well. And whenever we deal with the valuation, we'll get there. But you need to understand NMDC's biggest mode is low cost advantage. So of course, in this particular presentation, I'll cover the history, business model, and their financial, and growth prospects, challenges, risk, and in the end, we'll cover the valuation part as well. So a brief history of NMDC. So founded in 1958. So obviously it's a PSU company. So National Mineral Development Corporation, established by government, under the Ministry of Steel in 1958. And for the next 20 years, so it was in the development phase. So developed key iron ore mines in Chhattisgarh, Karnataka, and Madhya Pradesh. So in these three locations, this company focused in terms of development for next 20 years after establishment. From 1990 to 2010, again, that is also somewhere around 20 years, expanded the production capacity and became the largest iron ore producer. So today it is the market leader in India. So the biggest, I would say, like, it is monopoly. So biggest iron ore producer. And of course, NMDC is now focusing on steel production. So far, they are only into iron ore, but now they want to focus on the steel production as well. So forward integration, and of course, value added products. Nothing but launching premium products and global expansion. As of now, they are not very big in terms of. Of course, as a company, they are the sixth largest iron ore producers in the world, sixth largest, but relatively they are not generating that much of export business. Even today, almost 85% of their business comes from India. So going forward, they can capture that global market as well. And of course, today NMDC is a Navratna PSU with a monopoly in India with high grade iron ore market. So as of today, it is the monopoly. Coming to the business model, like how this company makes money. 98% of revenue is generated from only one business, that is iron ore mining. So we have already discussed Chhattisgarh, Karnataka, like they have mines with a reserve base of 1654 metric tons. That is the reserve base. Annual production capacity is somewhere around 54, close to 54 metric tons, but they have only produced 45 metric tons in 2024. So you need to understand this. 1654 is the reserve. Out of 1654, 54 is actually the production capacity in a given year, and in that 54, only 45 is produced. So there is, you can see like how much is left in terms of reserve. So of course they are exporting to Japan, South Korea, and China, but that export market is not very big, only 15% of the total sales. Domestic sales is 85%. So if you look at the revenue mix in 2024, 85% of their business came from the domestic market, and that is 98% of the business, by the way. So iron ore production or mining is their major business. 2% of business, which I would say the upcoming segment, is NMDC Steel. So the new growth engine. So I would say forward integration. So to manufacture steel, iron ore is required. So they have got iron ore reserves. So now they want to get into that steel manufacturing as well. So NMDC is transitioning from mining to steel production. So if you look at their steel plant, so Nagarnar steel plant, 3 metric ton per annum capacity. So it is fully operational, expected to drive higher margins. So obviously, this they are getting into this finished product of steel, where margins are slightly better. So pellet and beneficiation plans to improve efficiency, but it's a small business, only 2% of revenue. So don't take it seriously, because this business at this point is not going to move the needle much. But going forward, maybe in, let's say, 5-10 years, even NMDC Steel could also be a big chunk of, the NMDC as a corporation. But as of today, it's a small segment of the business, but promising segment. Coming to the future expansion, so the plan is to increase iron ore production to 100 metric tons by 2030. Now again, going back to this slide, 1654 is their reserve. Out of that, 54 is their capacity per year. And out of that 54, they are only able to produce 45. But their target, that is in 2024, 45 metric tons they were able to do. They were able to produce. But by 2030, their plan is production of 100 metric tons. That is doubling in 5 years. So based on their expectation, doubling in 5 years is somewhere around 15% CAGR. If you are doubling in 5 years, it means 15% CAGR they are expecting in terms of capacity growth. Of course, that's an expectation. Whether it will materialize or not, that's a different story altogether. We'll discuss that in the valuation. But I just want to put here like what the management is expecting. They want to expand or produce double of what they are doing today within 5 to 6 years. And one more new exploration they want to do is like lithium and other critical minerals in India and Australia. Maybe they have got some mines in Australia as well, but of course their major chunk of business comes from India, and it's a PSU Indian company. So they are trying to explore lithium and other critical minerals as well. But again, this is an option value. It is not yet done, so they are just exploring it. So I would say like we should focus on this. If at all we are investing in NMDC today, our focus area should be iron ore mining, because end of the day, steel will take some time, and lithium and all will take even, that's an option value we need to discuss. Now coming to the future growth drivers, first is of course infrastructure and the steel boom in India. So the government is targeting 300 metric tons per annum steel production by 2030, pushing the demand for iron ore. Of course, if you want to produce steel, iron ore is the input. I mean, iron ore is the raw material. So government is targeting for 300 metric tons of steel production, which indicates the demand for iron ore would also be great up until 2030. Railways, real estate, auto sector will drive the steel demand. Of course, that's anyway given. So the first is natural infrastructure growth or the boom in the infra and real estate market. So that is the first driver for growth. The next driver is low cost production and high quality ore. I've already mentioned NMDC is the lowest cost producer in the world, not in India. Lowest cost producer in the world, one being a PSU, of course, government related advantage as well, but with a production cost of 1000 rupees per ton. That is, ton is 1000 kgs. So every kg of iron ore, they are able to produce at 1 rupee, like 1 kg at 1 rupee. 1 kg of iron ore at 1 rupee. So they are the lowest cost producers in the world right now. So that is their biggest advantage, cost advantage. So, and of course, high grade ore 60, 65 fetches premium prices. So they are able to, they can produce this high grade ore and sell at an premium price as well. We are not discussing about the selling price. We are discussing about the production price. So they are able to produce that iron ore at the cheapest price possible. Of course, we'll get to the selling price as well. So expansion into value added products. But again, this driver is very small right now. Pellets, sponge iron, steel production will boost the margins. But again, that is just 2% of their business right now. But going forward, 5 to 10 years from here, that could be a biggest driver for growth. Last but not the least, debt-free cash flow and debt-free balance sheet and huge cash on the balance sheet. As of today, they have got almost 14,500, close to 14,500 crores of cash on the balance sheet. Cash. And most of it is in the bank. So in bank account, they have, it's not even liquid funds. It is in bank accounts. They have almost 12,000, 13,000 crores just in bank accounts. Remaining 1,000, 1,500 crores somewhere in liquid funds and something like that. So as you can see, the major growth driver, I would say, is this. That is the general, expectation in infrastructure spending or infra growth, and of course, NMDC being the low cost producer can of course grab market share globally as well if they venture globally going forward. Now, of course, with opportunities comes risk as well. So what are the challenges for NMDC? So the first challenge is NMDC, obviously steel or any commodity, is cyclical in nature. So cyclicality in steel demand is the biggest challenge for this company. So global slowdowns and oversupply can impact the iron ore prices. So again, being a commodity, supply and demand plays the actual game. So lot of oversupply, prices drop, lot of demand, prices goes up naturally. So there will be cyclicality in the industry. So that is the first challenge. Second challenge is high royalty and premium payments. So NMDC pays almost 37.5% in royalty plus premium, reducing the profitability. Of course, previously it was slightly lower, but now they have increased the premium as well. Almost 22.5% premium is added somewhere around in 2021. So what is this royalty and premium? NMDC doesn't have any captive mines, so they lease mines from the local governments. Let's say Chhattisgarh. So they make an agreement with the Chhattisgarh government. Let's say in Karnataka, they make agreements with the local Karnataka government as well. So they make some agreements, they make some deals, and also they have to pay a royalty and a premium on the average selling price. Now that premium has gone up recently, so which is putting some pressure on their margins. So of course, change in the premiums or change in the royalty can also impact the margins. Next is delays in the steel plant ramp up. But again, this is the new plant that they are setting up. Nagarnar Steel needs higher production and sales volume to break even. This is a recent fully operational right now, but of course, it should work at full capacity to break even the cost. So that can also put some slight pressure on the margins, but of course, that's a small portion of the business. But the cost can definitely have some impact in the P&L. So cyclicality, royalty, and of course, new plant being set up. So the operational cost can put some pressure on the margin. So these are little challenges that they have. What would be the mitigation strategy? Focus on high grade ore and cost control. Of course, getting into that premium segment and able to capture that premium market would help. And cost control, anyway, they are the lowest cost producer. So, showing that efficiency in terms of cost optimization can also help to kind of stabilize the margins. And one more thing, diversification into lithium and other minerals. Of course, they are trying to explore that space, but we'll not discuss on that because I would say this is an option value than real value that may or may not happen. So we are not going to invest in NMDC based on what they are going to explore. We are going to invest based on what they have right now. Whatever it is that we will consider as a bonus, whatever might be. It might be steel, getting into premium segment, or diversification into lithium. We consider all of that as a bonus. Now that is the basic narrative of NMDC. Now coming to the numbers part, first of all, if you look at the balance sheet, uh, slight borrowings, but the debt to equity ratio is pretty good. So financial health is strong. And if you look at the sales, you will find cyclicality in the sales growth as well. So 10,000 to 12,000, that's a 50% drop to direct 6,000. Again towards 12,000, again there is a drop. 25,000, there is a drop. So right now it is at 23, somewhere around 23, 24,000, close to that. So one thing you need to understand is the sales are pretty cyclical. Again, demand and supply. So if the demand is high, the prices go up, the sales would also shoot up. When the demand rise up, oversupply in that situation, the sales number might fall. So that you need to understand. But right now, as you can see, the sales are pretty intact as of now. But where we can see a fall is in the margins, operating margins. So if you look at the long term history, uh, actually right now it is generating the lowest margins. So you can clearly see the cyclicality, 69 to 63 to 42, again towards 57, uh, again towards 51, 57. So you can see there is clear ups and downs in terms of margins. And right now the margins are at all time bottom, all time low. So I would say the bottom of the cycle. Right now it is at the bottom of the cycle. So why? What is the exact reason? Despite higher production, so I've already mentioned this, 45.2 metric tons, that's what they have produced this financial year, more than 10%. Last year it was somewhere around 40 or 41. So this year they have done 45, which is 10% more than the previous year. So revenue growth is almost 21%. But the EBIT margins were under pressure due to rising cost and regulatory burdens. So what are the major reasons for the drop in the margins? So as you can see here, these are the key reasons. So first is higher royalty and premium payments. So under MMDR Act 2021, NMDC is required to pay a premium of 22.5% on the average selling price, in addition to 15% royalty. So previously they had only royalty of, let's say, 15%, but this additional premium of 22% is also added on their selling price. So obviously the cost is going up. So if you look at the actual effect, this increased statutory levies from 27% of revenues. This was only 27. The premium or whatever royalty cost was only 27% of revenues in 2021. But today it is almost 37.5 or 38%, significantly impacting the margin. So you can see here, this is almost 12-13%. 12-13% effect on the overall margins. So as you can see, this is what affecting, uh, this is one of the primary reasons for the margins to come down. So obviously this company will not go and touch its long term margins because of this new act, until and unless the act is changed, or which is not possible at this point in time. So what I would say is royalty related cost or whatever the pressure that it hampered the P&L is going to stay. That is the first reason, from 27% to 37.5. So that's almost 10%, 11% jump, right? So that 11% jump is going to stay. Next is rising mining and logistic cost. So higher diesel or electric cost pushed up the mining expenses, and of course freight and evacuation cost due to railway tariff. So overall the cost, be it logistics or be it mining, the cost has gone up. This is cyclical in nature. So this electricity or tariffs or evacuation, that is pretty cyclical. So that is going to revive going forward. Next is a decline in the realized prices of iron ore. So the demand is also going down. The production capacity went up, but realization value came down because of the overall price drop. So NMDC iron ore realization per ton was 4,800. Let's say 4,800 in 2024 versus, actually I think the numbers are reverse. This is in reverse. So the prices have gone down. Here in this, there is a typo, I guess, reflecting weaker demand and pricing pressure. So I think there is a typo here. So the current numbers are much lower than the last year's number. So that is the reason the margins have dropped. And global slowdown in steel demand, especially in China. China is one of the major reasons. So the slowdown in the steel segment will definitely affect the iron ore segment as well. So reduce the ability to pass on cost. So again, this is also cyclical in nature. So weakening of demand, lower realization, even logistic cost, electricity or diesel cost, that is all cyclical in nature. So point 2 and point 3 is cyclical. Point 1 is not cyclical. Point 1 is slightly structural because it is related to government regulations. The fourth reason is higher capital expenditure on newer projects. So like I already said, they are spending some money on the new project. They want to forward integrate themselves and get into steel as well. As of now, they are only operating in iron ore. Going forward, they want to operate as one of the biggest producers of steel as well. So NMDC spent highest ever capex, almost 2066 crores, 17% above the initial target. Maybe they thought they'll spend somewhere around 1800 or 1900 initially, but now the cost went up a bit. They spent almost 2000, more than 2000 crores just in 2024. So investments in this particular plant is for pellet plants and mining expansion product, higher depreciation, lower short term margins. Again, the depreciation cost went up, but this is also one time cost. So as you can see here, once the plant operates at full capacity, this particular plant is also going to bring in a lot of revenue. So right now there is only cost without any revenue. Going forward, there will be cost, but the revenues will be much bigger. So this is also one time expense, I would say. So this is not going to sustain on the P&L forever. So once the sales or once the production starts, once the plant performs at full capacity, things would change. So out of the four reasons that I have provided, one is structural, three are cyclical. So what is next for NMDC? So iron ore prices are expected to recover, which eventually will improve the realization, which will eventually improve the margins. New value added products like pellets, sponge iron will boost the margins. It might take some time, not immediately, but like I said, once that business also comes into maybe 2 3 years, I would say, or let's say 2 years minimum. So we will see some difference in terms of margins. And by the way, that plant is for premium products. So that plant is going to generate a much higher margins than their current whatever they are producing currently. That particular plant is going to generate much higher margins. Long-term efficiency improvement and logistic cost control in focus. Again, that is one of the cyclical reasons I have mentioned. So that can be optimized. So what is the final takeaway? So margins dropped due to rising royalties, higher mining and logistic cost, and of course the pricing pressure. And like I said, there are so many other reasons. NMDC remains a low cost producer, and efficiency improvement could drive future margin recovery. Having said that, of course, I'll mention this in the valuation. So what I want you to understand here is, right now, because of some major one structure and plenty of cyclical reasons, the margins have dropped, but the margins will revert back, if not towards the long term average, but almost to that extent. There is a possibility with things changing, demand coming back, realization coming back, or let's say all these electricity or crude oil prices, once they normalize, they stabilize, things would change. Now before we wrap it up, we'll get into the valuation part as well. So whatever I have covered so far, you will see it reflecting. So first, as you can see, the current year's revenue is somewhere around 23,400, close to 23,400 crores. Now first, let's look at the revenue growth. Like I already said, there is a story behind this. So what the management is expecting, Right now they are at 45 metric ton capacity, 2024. By 2030, they want to, produce 100 metric tons, which is a double in terms of, production. So generally, double in production, I would say by 2030, that would mean double in terms of sales, or if not double, close to that, whether there is weak demand or whatever. So they want to double their sales is what the expectations or what the guidance would be, but let's not take that guidance seriously. So first let's look at reverse DCF and see what the market is expecting from NMDC right now. So based on my assumptions, what the market is expecting is a negative 7% growth, not even positive. So market is not expecting the production will go up, the capacity utilization will go up, they'll start a new steel plant, things would revive, the demand would come back, realization would. Market is not even expecting that. What market is expecting is, going forward, this business would drop. So iron ore is going to slowly, evaporate from the market. So people are going to stop buying iron ore or steel for that matter, is what the market is expecting. So you can see -7% is what the market is expecting in terms of sales growth. And if you look at the margins, the current margins, here you can see the current margins. I hope you can see the screen. So the current margins are 33%. And what I have mentioned, that margin drop is almost at the lowest level right now, at the bottom. So there is scope for the margins to revert back, because most of the reasons are cyclical. Except for one reason, remaining are cyclical, so the margins can go back. But what the market is expecting is the margins will drop even further. From 33, margins will drop to 30. So what market is expecting is there will not be any revival. And if you look at, yeah, these are basic assumptions. We'll get back to other assumptions later on. So as you can see, the current share price is 64 and the value per share is 64. To get here, we just try to, reverse engineer the numbers and see what exactly market is expecting. And market is expecting liquidation of the business and drop in the margins eventually. But I think this is pretty pessimistic narrative. What I think is this. So if I look at the past of NMDC, the last 3 years has been great. 5 years is also great. 7 years is almost 13%. But if I look at a 10-year period, of course, this is not the right way to look at a cyclical company. But if at all I look at the last 10 years, there is 6% compounded growth. So what I assume is, I'll be very conservative here. I'll just put 6% for the next 10 years also. What the management is expecting, doubling their capacity, doubling their production capacity in 5 years. But what I am saying is only 6%. Doubling, by the way, is 15% growth in next 5 years, but I am not expecting 15%. So here you can see for the next 5 years, I am expecting only 6%. Got it? And what the company managed to do last year, 13% they have done last year itself, which is, I would say, last trailing 12 months, last 4 quarters versus the previous 4 quarters. So that is 13% growth. I'm not even inputting 13%. I'm just saying 6% growth. Very conservative number, right? And from there on, from 6th year to slowly it will move towards 4%, which is our terminal growth rate anyway. So overall, what I'm expecting is only 5.4% growth in 10 years. So if you ask me like what is your 10-year CAGR expectation sales, I would say only 5.4%, which is in line with its long-term growth. That is my first assumption. What would be my next assumption? It will be on the margins part. So if I look at the margins, the current margins are obviously at the lowest, 34, which is the lowest. And here you can see the long-term average is somewhere around 45.75. From 45, the margins dropped towards 34. And if you look here, in 2021, the margins were 55.7. This is before the new policy, that is 2021 new policy basically shifted the royalty and the premiums, so which added a 10% more pressure over there. But having said that, from 34 the margins should improve is what we are assuming. But like I said, this margins and premiums and royalty, I would say, is a structural issue. It's not a cyclical issue. So I think the margins will improve, may not go back to 45 or 46, but I would say maybe towards 40%. The current 33, 34 to uh, around 40% is what I am assuming. Not 45, I would say 40%. So as you can see, when I change these two numbers, so from -7 to a +6, from 30 to 40, as you can see how things changed. So value per share is close to 110. Share price is 64. Now I can change one more thing as well. So if I look at the long term, if I look at the current sales to capital ratio, it is somewhere around 1.59, but the long term average is 0.85. So I still considered 0.85 as my sales to capital ratio. So as you can see, I have incorporated the possible conservative numbers. So I am not going overboard. I am not being extremely aggressive here. I just try to input like whatever I think is reasonable. For example, by 2030, if NMDC can really clock 100 metric tons, that would be somewhere around here. So by this year, NMDC would be generating, let's say, 45 to 50 crores, 50,000 crores. There is a possibility, but still, we try to be little conservative. But it is okay. It's always best to be conservative because I want positive surprise than negative shocks. So with my extremely conservative numbers, the value per share today stands somewhere around 110 rupees. Conservative. That is the key point. If I can make it a little aggressive as well, and I can raise the number to 130, 140 or 150 also, that is possible. Because if I can say like there is a possibility that the margins can go towards 45 as well. So the numbers would improve, but I'm not doing that. I'm just trying to be very conservative. So 110 versus 64. So that is one of the reasons why NMDC is recommended. And of course, on the top of that, you can see here almost 15,000 crores of cash on the balance sheet. That is one more good news. So chalo, that's it for today.